This simple trick will help you pay off your mortgage faster. My name's Evan Kaufman, your VA loan originator, here to help explain. So why even would you want to pay off your mortgage in the first place? Some people are like, Evan, I want to get the longest mortgage I can forever with the highest amount so I can take that money and invest it elsewhere. I get it. I had an economics degree, finance. I understand where that's coming from. However, we have a client 20-year vision where we like to see our folks have a paid for, near paid for home by the time of retirement. Why is that? Because there's just a certain different kind of security that you have going into that time frame. And as much as numbers can sometimes make sense, they don't always make sense for you personally. So let's decide you said, hey, Evan, I do want to have my home paid for. Maybe I'm still going to have investments and other things, but I want to see what does it look like if I did get my home paid for or paid off early. Well, there's a couple tricks you can do. We're going to talk about two of them right now. Let's look at making sure that you make that first payment, or I should say an extra payment every year going specifically towards principal. If you do this, you could shave off 4 to 6 years of your mortgage, maybe even a little bit more depending on where your interest rate is. All that simply means is every year, try to make sure that you save up enough extra cash, or let's say you get money in from some random event that sometimes happens in life, and you make one extra mortgage payment per year dedicated specifically towards principal. Meaning that the money's not going in as an extra payment to cover like a future payment. It's going in to directly pay down your principal balance. Because remember it this way, when you take out a mortgage, in the beginning, this much of your payment goes towards interest and this much goes towards principal. It's how loans work, amortization. We'll have to do a whole other video on that. So what that means is you putting extra money towards your mortgage and paying down that principal earlier in the life of the loan makes a bigger impact. So especially if you just started your mortgage and you can get that extra payment once per year and put it towards principal, it has the biggest impact. So when that money goes direct to principal, it reduces your balance. It means that your payment's going to stay the same in the future. It's not going to move. However, it will adjust your amortization table to where more money is going towards principal than it is towards interest. And then every year when you put that extra chunk of principal on, it just knocks it down a little further. It's a bite-sized way to knock down your mortgage pretty efficiently without taking up too much extra income. So effectively, one extra full payment per year dedicated specifically to principal, shave off around that 6-year mark, give or take, depending on your interest rate, it can be a big benefit. The second way that you can try to lower that payment a little bit quicker is that look at making your monthly payment, and rather than doing your monthly payment once per month, do it every 2 weeks. So in the same way that some people effectively are paid bi-weekly versus bi-monthly or monthly, bi-weekly people who get paid technically get more paychecks. Doesn't mean they necessarily make more each year, as we see a lot of loan applications. It just means that their checks are broken out differently than the folks who pay monthly. So effectively, rather than making one mortgage payment per month, make one half mortgage payment every 2 weeks. Just like if you're being paid every 2 weeks, you make it half that mortgage payment every 2 weeks, and you'll ultimately put an extra full payment towards principal again by the end of the year. Now the key there is sometimes you'll get things in the mail saying you set up a program, do this, we'll advise you. Sorry, you don't need to do any of that, but if you're doing that bi-weekly option, know that you want to see if your servicer has a way to make sure that the extra payments that you're going to do in the year go towards principal at the end. That's why me personally, I prefer the route of, hey, how can we make sure that we throw down that extra monthly payment towards principal specifically sometime in the year? Let's say your mortgage payment is actually $1,200 a month, keep it easy, and you want to make that extra payment towards principal over the year. Well, rather than pay $1,200 a month, pay $1,300 a month and make sure that extra 100, it's usually pretty easy in most servicer accounts, that 100 is going towards principal pay down. If you do that, then your mortgage payment's just slightly higher, but then that pain of making that extra payment is spread out over 12 months, making it much more manageable. So by the end of the year, you've put an extra $100 or an extra 1/12 towards that principal, and you're gonna shave off a lot of that loan. Heck, make it $150 and get yourself almost a decade shaved off the loan. Pretty wild in the end, right? So there's ways to definitely do debt consolidation on a mortgage if you want to, especially when rates are higher, it can really make sense. So if all of a sudden interest rates are 6, 7, 8% or whatever you have on it, and it's relative to other investments, you know, it's actually a worthwhile deal to pay it down, there's no shame in doing so. And those are a couple tips to help you do exactly that. My name is Evan Kaufman, again, your VA loan originator. Hope this helps. Bye.